So today what we'll do is we'll maybe finish up. We probably won't get all the way through manager attribution, we'll see. But finish up the class project talking first about historical value at risk, which is the most bizarre part of this project to be sure, because it's something you would not probably do in practice, but I want you to show you why it's so important to consider this when you're doing any type of portfolio recommendation. Then we'll get into style analysis, which I really enjoy. I think it's a really powerful skill to have. And then manager attribution, which is something you could actually go away and immediately apply to portfolios your parents have or grandparents have or other relatives or friends. So it's a pretty powerful tool that you can do immediately. So here's the file we did last time. We built an efficient frontier. I put the zeros back in here, so remember when you're doing these charts, when you come up, you'll have your zeros will be showing. Once you get your very final portfolios, then I would go back in and just get rid of those zeros. They're hard to bring in and bring out the way this particular pie chart is created in Excel. But so this is our final recommendation. We built our efficient frontier, so there's the portfolio we're recommending. There's the current portfolio, so we have a nice looking efficient frontier. So now we want to jump to this next page, which is called historical var. The historical var is going to bring in, as long as you have it set up in the right place, your current portfolio. That one will always be correct unless you really change something on the file. And then as long as your recommended portfolio is on line 13, the green line here, then this will bring you, see how that's bringing in line 13, then this will be referencing the right portfolio. And then you have to do a risk tolerance. Now risk tolerance, the main issue with risk tolerance is you got to pick a number. So if you're using a younger person, you might go as high as 5%. If you have an older person, you might go as low as, say, 0.2% maybe. 0.2%. So I just can't get it there. So 0.2%. And then I'm using this function here, which is an interesting function. Remember, the function we used before was norms dist, and then you would put the number of standard deviations, and that will give you the probability. Remember, the table might give you, like, if you did 1%, the table might give you 2.33, some value like that. So that's the norm dist function. This function here is norm.sinv. You have to do minus because of what side of the tail we're looking at, but norm.s.inv for your probability. And so you can see a 1% gives you that 2.33, the 5% gives you the 1.64. I'm going to use 1%. So you do have to talk about this a little bit in your paper, but the key is, older, you're going to be somewhere around the 1%. Younger, you might get to 5%. I doubt anyone's going to be higher than 5%. Remember, with your banks, when you're looking at value at risk, you probably saw some 90% and 95%. So 90% would be 10%. From our standpoint, we're doing the other side of the tail. I'm always thinking in terms of downsides, so 10% of the time, whereas banks are saying 90% of the time we won't lose more than this. So yeah, 10 on a daily VAR, 10 is possible, but we're doing an annual VAR here, and 10% would be pretty extreme. That, you know, this is a 1 in 10 year event. Here we're looking at a 1 in 20 year event. So 5%, so somewhere in that area. You just have to talk about it quickly. I'm not looking for paragraph after paragraph after paragraph here, but a couple of sentences to explain why you picked your risk tolerance. And then we'll come down here to the numbers. Now, if you get some older videos, I used to do this on a monthly basis, and it gets really confusing on a monthly basis. I've converted to an annual basis, so it's, I think, a little bit easier to understand. But anyway, here's what we're doing. I'm bringing in historical data from 1988 to present. So about 30 years, a little more than 30 years, are pretty good. It's hard for me to think that 1988 is 30 years. I was already out of college in 1988, so it's pretty amazing. So over more than 30 years ago, kind of amazing. So quite a bit of data here. You do have to realize that a 1% risk tolerance, that's going to make your historical VAR essentially the third worst year. So it's not, if you do a 0.1, then you can't even get a true historical VAR, because that would be a 0.3 year, so be essentially your worst year. So when I pick 1% versus, you notice if I go up to 5%, it changes my historical VAR pretty dramatically. So I'll do 1%. All right, so what are we doing here? First of all, we're doing something that a financial planner would never do because it's too embarrassing. I'll give you some answers for why this is the case, and I actually think financial planners should show this. I also believe that if someone's using a financial planner and they're given a efficient frontier type of output, that they should ask for this historical VAR. They should actually request it, and then you'll watch the financial planner not have a clue what you're talking about. So I think it's important to at least see it and then try to reconcile why what they're recommending using a parametric value at risk, using standard deviation and means, differs so much from history. So if you look at a first frontier, what we're telling the client is we're going to have the same risk as your current portfolio, but with a higher expected return. And we see that, right? Here's our assumptions. We're going to have a higher return, and the risk is lower. Now here the risk is different. Here on the efficient frontier, the risk is standard deviation. So we're using standard deviation. Here we're converting that standard deviation into a 1% event. So if you look at the parametric numbers, I'll put them in orange. So the parametric numbers looks just like the graph. Our risk is almost identical, not exactly identical. And the reason for that, reason it's not exactly identical is because the returns are different. Remember, the parametric VAR takes the expected return minus 2.33 standard deviation. So there's your parametric. So this one is actually going to be a higher VAR because we have a lower expected return. The standard deviations are the same, so the risks are the same, but the 1% event's going to be a worse loss because we have slightly different expected returns. So the difference in expected returns times 2.33, that should be the difference. Now we get the historical VAR. Historical VAR just looks back at history and finds the event that's the 1% event. And historical VAR actually takes the actual averages of these different allocations. And if you look there, we've got a huge problem. Because historically the portfolio that our customer currently has actually has a higher return than our recommended portfolio. Now the good news is it was riskier, so that's nice. It did have a bigger loss, not much. So we're telling our customer we're going to give you a portfolio that has about the same risk but a higher expected return, and in reality our portfolio historically would have had a lower return with a lower risk. So how do you explain that to the customer? Well, let's go back to the model output, and we might be able to explain it here pretty easily. So if you notice, we have a large allocation to emerging market stocks where they didn't have any to emerging market stocks. We have large cap value, they have large cap growth. Now we know growth has come back pretty strongly the last few years. We also know emerging markets just have not done well. The other thing you'll notice is the high yield, the high allocation to high yield, that's probably going to have some impact. So, the bonds, we have 16% in bonds. They had 30% in bonds with a heavy allocation to yield, a high yield. Yeah, these allocations can have a huge impact. One thing in particular, and you don't have it here, but if we were to put a lot into developed market stocks, they have done horribly the last 30 years. So if your model actually allocates to them, then historically they've done horribly, but going forward we think they're going to do pretty well. And that's part of the challenge of this historical versus parametric. Historical is using historical numbers. One thing we know with bonds, the past 30 years is much higher return, much higher return than expected. Why? Because of the high yields in the 1980s. That's kind of a huge impact. Interest rates were, double digits. I don't know, like in 1988, probably not that high, but well above 7-8%. And now interest rates, the 10-year is barely getting above 1.5%. Might run up to 2%. We're starting talking about a 2% 10-year Treasury being a high yield, but historically, the 10-year Treasury has been well over 5%, especially back in the 80s. And the other thing is, the developed markets, they had terrible returns the past 30 years, as did emerging market stocks. So if the model is, if your customer had a high allocation to bonds, and now you're reducing that, that's going to make your parametric VAR look worse than historical, because bonds have done so much better historically than you would expect going forward. If your model's pushing more into international stocks, that's going to make the historical look better than the parametric on a return basis, because those stocks just have not performed nearly as well as our assumptions assume. Now, what's your customer going to ask? Well, I had this debate actually with a person who became UTSA CEO after I retired. He was upset. Why are you guys assuming such low returns on bonds? And there's people wanting us to assume bonds are going to make 9, 10, 11, 12% when their yields were 3 or 4%. And this was someone with a financial, actually had a CFP, which is actually a financial planner. But you can just see the difference between financial planners and investing is very different backgrounds, very different trainings. And he really did not understand that, bonds have high returns when interest rates start high and they go low. For them to have high returns going forward, interest rates have to keep falling and falling and falling. And it's just not going to happen. It's just not possible for interest rates to keep falling and falling and falling. I know they've gone negative in certain places in the world, but it's hard to think of a 10-year Treasury being -5 or never -6%. It's just kind of ridiculous. So 0 or a little bit below 0 is somewhat of the floor. And so it's just very, very tough for bonds to make high returns going forward. Now, who knows about international stocks? People are saying this is the best time to be in emerging market stocks. They've so underperformed other asset classes. It's a great time to be in developed markets, people say, because they've so underperformed the U.S. That may be true. Your customer may be a little upset about this. So how are you going to explain this in your paper? It's going to be interesting to me, because it's not easy. It's challenging. But I'm wanting you to do it because I want you to know there's this big thing out there that our profession simply ignores. Financial planners, whatever, if they're working for Morgan Stanley or UBS, they just accept the assumptions they were handed, and they never think to compare this to history. And plus, this historical would change dramatically if we went back to maybe the 70s or to the 60s. Or if we started in the mid-90s, we would get different. So the historical changes quite dramatically depending on the time period that you picked. Over on the right, you don't have to go over here, but if you wanted to, I show you the portfolio. If you go that entire period, 1988 through 2020, or if you only go through 2007. So if you leave out the huge crash of 2008, and here you notice you get very different answers as well. Look at your return. Here the returns are about the same if you do the entire period, but if you only go through 2007, you can see your recommended portfolio did a lot better. And if you look at risk, if you use all the periods of time, your portfolio is lower risk. Go through 2007, it's lower risk. So it doesn't matter the 2008 crisis doesn't change the relative risk of the portfolios, but has a huge impact on the relative return. So you notice the risk goes from 16 to 14 and 15 to 12. The returns are about the same if you use all the periods, although my recommend is slightly lower. But if you stop at 2007, you can see our returns much higher. So just the period of times that you pick can have a huge impact on the historical. And so now I've used historical VAR. I remember I had a CEO when I wanted to do the pension balance sheet immunization. I had a CEO who did not like parametric value at risk. He did not like models. He called them black boxes. He was so dependent. I understand he was so dependent on our assumptions. And how does he know if our assumptions were any good? And so he loved historical VAR because he knew his history was history. It's something he could go check. And so I would use historical VAR to show him my recommendations. Now I would tell him, I was very honest. I would tell him, okay, I'm telling you about a pension ALM problem where I'm trying to hedge the risk of interest rates falling, and I'm showing you that with the last 20, 30 years worth of data, which was a period of time where interest rates did almost nothing but fall. So the numbers I'm showing you are really favorable, and he would understand that and acknowledge this, but he said, but these are the numbers. And I said, yes. And so I knew, showing him historical VAR, I was greatly exaggerating the value of the balance sheet immunization, but he didn't care because he trusted historical better than parametric. So I could have used that to my advantage, because that's the huge thing with historical VAR. If someone wants to see historical VAR, but they don't tell you what period of time to pick, you can get any answer you want by just changing the historical period. I didn't do that. I used all the data I had available to demonstrate to him what I had. Now it worked out really, really well, especially in 2008. It ended up saving us, well over $1 billion. But that was just pure luck because of what happened in 2008. But it does show you that historical VAR has that negative side to it, that you can get almost any answer you want by just changing the period. We talked about this some with the guy who wrote Random Walk Down Wall Street. He was making an entire presentation where he's making these very strong assertions that were totally dependent on the time period he just happened to be looking at. All right, so there's your historical VAR. I'm giving you some kind of ideas of what you can talk about in your paper. You'll have to come up. This is the part of the paper where it's really easy to run the numbers. That's a piece of cake. But what you're going to actually say is you're only going to talk 2, maybe 3 paragraphs. So the historical VAR is not a long part of the paper, but it's a chance for you to show some good critical thinking. To step back as a finance major or an actual science major, all the statistics you have, everything you understand about means and standard deviations, and give me a good, well thought out answer that makes sense given the data that's before you. So there's historical VAR. Now the next thing we're going to do is style analysis. Now style analysis, you'll have to watch real carefully how I do this particular project. I am going to use, and listen real carefully, this is extremely important, I'm going to use the Vanguard Balance Index Fund. Its ticker is VBINX. You cannot use that fund, but what can you use? So what you want to find is a balanced mutual fund, or ETF. It can be either one. What does balance means? It contains both stocks and bonds. Sometimes these are called asset allocation funds. Just depends. So you want to find some type of balanced fund. So how do you do that? Let me show you a few ways you can go look for one. So this is Vanguard's website. Vanguard's just one example. Go over to Personal Investors. Now you can also use this site when you're doing the manager attribution if you like. So I'm not going to log in. what I want to do is find Vanguard's funds. So I'm going to go down to the very, very bottom. It says down here, investment products. I'm going to click on that. Mutual funds. They do have ETFs as well, the Vipers. So we'll click on the mutual funds. It says explore our mutual funds. So I'm going to click on that. Then they give you more options than you really want to. But right here, they give you some choices that you could actually, well, here they're doing by asset class. That's what you want. If you know a particular fund, you can do by fund name. But let's do it by asset class. So the asset class we're looking for, we're not looking for mutual fund, money market funds. We're not looking for bond funds. We aren't looking, okay, so we are looking for balance funds. Now we probably don't want target date funds. And the reason for that is target date funds, they change their asset allocation every year. So it's a moving target. And with style analysis, what we're trying to do is figure out their asset allocation. But if it keeps changing every year, that's going to make style analysis really tricky. Definitely a target risk would work. Traditional, and that's where you're going to see where the one I'm using is one of the more traditional funds. It's not even listed in here, so we'll have to, let's see, I don't think it is. I don't see it in here, but traditional funds. Star is one that you could definitely use. The Wesley income is possible. So these are traditional type of funds, even they have the word balanced in them that you could use. Not a lot of choices there. This is Fidelity. Fidelity, the same thing, investment products, mutual funds. Explore fund offerings. Stock funds. So, stock funds, so mutual fund investing ideas, all mutual funds. So you're just trying to find something that shows all of them. Equity, sector funds, international. Here we have asset allocation funds. Asset allocation fund picks from Fidelity, Morningstar. Asset allocating funds by fund family. Let's do that. So you just have to kind of hunt around until you find them. It's most of their websites are set up that you've got to do a lot of extra work because it's somewhat like HEB where they put the milk in the back of the store and they want you to do some impulse buying, so they're hiding it. So you can see a list of funds here. One thing I like about Vanguard is they give you the starting year for the fund. This one doesn't do that, but make sure they have at least 10 years of history or it's not going to work well here. You can see with Fidelity, this is their fund platform. So they got a lot of funds that aren't even their funds. So this one can give you a lot of ideas. So you're looking for asset allocation funds, and this is not a bad website here to use because they've got a bunch of them. So you can just look through and try to find one. You might have 3 or 4. There's some T. Rowe Price in here. Try to avoid the funds that have a year in them, like 2045 and 2050. Those are target funds, and those are the ones that change their allocation over time. So that's not a good one to use. You can look at, there's 15 pages of these things. So there's places to find them, but I'm going to use the VBINX. VBINX. That's the only one you cannot use. So what I need to do is I need to go into Yahoo Finance, and over on the quote you type in the ticker VBINX, not VBINX, but whatever mutual fund you pick, you click in that ticker. And Yahoo Finance will bring up the data on that fund. You can, if you want to, you can click on profile if you want to look at it in Vanguard and in Yahoo Finance. They'll give you some sense of who they are. You could do holdings and get a little bit of a sense of how they're allocated. So there is some here. You can see they're saying this is a 60% stock, 40% bonds, but what we don't know is, hey, does it have any international stocks in it? Does it have high yield bonds in it? So this is the reason I picked one is a very traditional 60-40 stock bond fund. It shows you the allocation to industries. It does show you that it's entirely investment grade, but we'll see about that. Shows you the top holdings. You'd expect it to be the top holdings would be the largest stocks in the U.S. There you have your FANG stocks right there, with Microsoft added in. No, I don't see any Netflix, but there's your stock. So everything is makes sense. This is a good fund. So the problem is you can't use this fund. So once you see a little bit about your fund and what they do, then we're going to go to historical data. And what we want to do, I'm just going to click on the max. And you see the max goes back to 1992. So if you click on our website, on our Excel file, we need to go back to October 1992. So I go back over to the website. And this one starts September 1992, so that's good. You can go back as far as 1988. But you don't want to go back beyond 1988. So this one starts in 92, so that's what we're going to use. We're going to use all the data they have. So if you go back beyond 1988, just be aware, the furthest back you can go is January 1988. So if your fund goes back to 85, 86, 84, then what you will want to do is change your starting date to 12/31/1987. You don't want to start any earlier than that. However, if you click on max, and the max is after January 1988, you're good. You don't need to do anything else. We want historical prices, and then we want monthly. All right? So max on the time period. If you go beyond 1988, then click 12/31/1987. You want historical prices, and you want monthly, then click apply. And then download. And once it downloads, you open that file, and we'll do a little bit of editing inside the file itself. So I'm going to spread out the dates so you can see I go back to 10/92. So you're going to do a few things. First of all, we don't want the volume column, so you can delete that. We don't want the open, the high, the low, or the close. So you can delete those columns. All we want is the adjusted close. The next thing is that first month is probably not a true first month, but we can leave it in there because it's going to be the last number there will actually be the last day of the month, which is what we want. Let me explain the adjusted close here so we know why we're using adjusted close. So stocks, when they pay dividends, and the stock price will fall. So it gives you the actual closing price is distorted. Anytime the mutual fund pays a dividend, the stock price, and here in this case the mutual fund price, or the ETF, whatever you're using, its price falls. And so it makes it look like they lost money, but you didn't lose money. So let's say they pay $1 dividend. Your mutual fund price falls $1, looks like you lost $1, but then you get the $1 dividend. Well, if you only use the closing price, it's going to make it look like he lost money every time they pay a dividend. So the adjusted close brings the dividend back in for a true total return. Price and income is in your return. That's what we want. That's why we want the adjusted close. All right. So I'm going to take this now. I'm going to do Control down to the bottom. Hit the Control button and your down button. We only can go through December 2020, so I'm going to get rid of these last few months. We don't need those. And so what you want to do is highlight the first month. So put it on that first month. And then hit your shift button, your control button, the down arrow, the right arrow, or just take the lift up, keep the shift button down, and hit right, so you have all of that highlighted. So you only want those two columns highlighted. Then do Control C the copy. Go back over to our model. Come back over here in A9. Right click and paste as values. So right click and hit that 1, 2, 3 so it pastes as values. And what we're doing is we have your funds return. Your funds return is simply the adjusted value this month divided by the adjusted value last month minus 1. So this fund made 2.2% this month. The best match, using whatever allocation is up here, the best match was over here with that allocation. So if we go to 1092, we can see that return. It's kind of off by a month the way I have it set up. But 219. So actually it's 1192, 219. So that gives you return. All right. So that's all you've got to do. Just show you the steps again. You find a mutual fund. You go to his history. You click on this, click on max. If the max is before January 1988, then change your beginning value to 12/31/1987. You want historical values. Hit monthly, make sure it's monthly. Apply, then download it. When you download it, get rid of everything except for the adjusted close. Highlight from your starting month all the way down to the very end. Hit Control C and paste that as values. So right click and click on the little 1, 2, 3 as values over here, and everything else is set up. Then what we're going to do is do just like we did before, data solver. So let's look at solver in this case. What we're saying here, so we want to maximize. This tells you exactly what style analysis is. So we want to maximize the R squared between the returns on my mutual fund and the returns on our asset classes by changing the allocation here. See up in B2, our allocation in B3 through J. So how can you change those allocations? The only constraint is we want that allocation up to 100%. So we hit solve, and Bill Gates will do his magic. He found the solution. You can see we can explain 95% of the volatility in this Vanguard fund by this allocation to our indexes. And that is what style analysis is. So I haven't really told you what it is until now, but style analysis, you're trying to explain the beta risk taken by a balanced fund. Where are they taking their risk? What asset classes are they exposed to that you can best explain the volatility of the fund? So you can see with this fund, we're able to explain 95% of the volatility of this fund with this allocation. Now, what is this allocation? It's 30% large cap growth, 23% large cap value. So you can see it's a very large cap fund, very little small cap. No international, so that's interesting. No gold, and 39% bonds and 6% high yield. So what we saw on Yahoo Finance said that it was 60% stocks. Well, we only have 55% in stocks, so it's not 60. And we have a good 45% in bonds, not 40%. Now the high yield is somewhat of an in-between between stocks and bonds. So this bond fund probably does not have any high yield in it. However, its characteristics make it look like it has high yield in it, which is interesting. So that's the best explanation. So how are you going to do this in the paper? So this is the part, some students get so confused on this part of the paper. I know, I'm just going to predict now, out of a class of 60, at least 6 or 7 of you are going to email me, call me, Professor Sweet, I spent all weekend working and working and working. I just couldn't find a mutual fund. And what they were trying to do was try to find a mutual fund that matches their recommended portfolio. That is not what I'm asking you to do, all right? Let me say that again. Still, people are going to miss this. I would bet $100 that someone, at least one person, if not 5 or 6. I'm not asking you to do that. So what are we doing with style analysis? Let me be real clear. Pretend like your customer comes in with a mutual fund. And they say, okay, you're recommending this portfolio. I just want to let you know, I already have a mutual fund. It's the Vanguard Balanced Index Fund. I'm curious, can I use that fund for what you're recommending? And your answer almost 100% of the time, if not 100% of the time, will be no. You cannot use that fund. Why? Well, and you might, if you want to, you could create a pie chart. I would think it'd be really interesting if you added a pie chart. What if you did another pie chart? And we could even do it really quickly if you wanted to. Another pie chart that shows the style analysis. I'll let you build it yourself. But if you do another pie chart that does the style analysis, and this is no longer, so I'll see if any of y'all will actually put this in your paper, because I just thought of this now. This is the client mutual fund. It's not their portfolio, it's their mutual fund that you're doing style analysis on. And you compare those, you get those zeros out of the way, and you say, wow, these are very, very different looking portfolios. And I wish I could get the zeros out of the way without it messing it up forever and ever and ever. I don't know what happened here. So there's some mess. Something's messed up. In fact, the bonds should have been in there somewhere. So something got messed up somewhere in here. Not sure why we're not showing. There's the 16. I don't know why it says 16% or 6. I don't even know what the 6% is. That's high yield. So not sure. So something got messed up. Let's see if we can get the titles to work. Yeah, everything's good. Yeah. Okay, so good job, Bill Gates, whatever you're doing. There it is. It worked that time. All right, so you can now compare the two mutual funds. You can see my high yield 6 in this client's mutual fund. I have no high yield. Large cap growth is 30. I don't have any growth. Value's 23. Small cap, I don't have any small cap. They have 2%. So I have emerging. They don't have any international at all. So you can say, so your answer is no. This fund you cannot use this fund. It is radically too different from what I'm recommending. All right. So if you spend 20 hours trying to find a mutual fund that matches this allocation, I'm not going to feel sorry for you because you weren't paying attention. So those 2 or 3 students, I mean, it's bad that you wasted a lot of time. You only need to find one mutual fund. The other question students have is, how high does this R squared need to be? I like it to be above 80%. To me, the key is the style analysis graph. You want something that's not so radically different that you really can't see anything. So you don't want one line going way up here and one that's flat way down here. It doesn't have to be as tightly matched as these two funds are, but you need a decent looking graph here. So here's the Vanguard fund, and here's the best fit style analysis. And so when I do that, I can say, yeah, the orange line does a good job of explaining the blue line. All right, so that's what you're looking for. So what I'm going to tell you is see if you can find a mutual fund that works. And you all on your own, without me helping you, you get the whole thing done. But if after an hour or so you're lost, you just can't get it to work, you've tried 2 or 3 different funds and nothing's working, then come to me. All right, so try your best to figure it out, but don't spend 20 hours doing that. That's when you're going over to the ridiculous side. But at the same time, in your first job, you're not going to have a professor or suite to call on. See if you can figure out on your own. This is the critical thinking. Finance jobs have very little help, very little training. You've got to learn how to figure these things out on your own. So see if you can figure out on your own. If you can't, it's not defeat, because unlike in your first job where you'd be using your own spreadsheet, you're using my spreadsheet. So I understand that you're using somebody else's Excel spreadsheet. That always creates a little bit of extra challenge and confusion. But do your best. Try to find a fund that at least gives you a decent chart. Get your R squared. I've seen R squares as low as in the 60s and 70s. If you're below 50, then probably the fund is not working. One reason Vanguard works well is that they tend to use index funds, and so they're already very similar to these indexes. And so using them usually gives you a good solution. But you can find others that will get you at least in the 70s and 80s and have a pretty decent. And I love this chart. This is a great chart. What I would like to add to this chart would be the asset allocation. So I would like to, it'd be really cool. Some of y'all, I really love it when students go beyond just the basic of what I'm asking for. If that's all you do in finance, your boss says to do this, so you do that. You don't do any additional analysis. You don't try to enhance the story, enrich what you're telling, make it more powerful. Then you're not going to get promotions. So start thinking like a finance professional or actual science professional. What can you do to enhance it? And it'd be great to put this in your paper with this pie chart that I just showed you, but not sitting here, but this pie chart, you could put this in your paper, these two pie charts, but you also could put this pie chart on your style analysis chart somewhere down here that shows, or maybe a table that shows what allocation got these two to get you the best fit. There's all kind of things you can do to add extra analysis. All right, so there's the style analysis. There's an article by William Sharp that he explains this. If you want to read that article, I showed it to you in a previous class. I'd recommend, if you don't have time during the semester, I'd recommend you put it aside, and when you have your first break, maybe when you're doing the 5-hour flight to New York for your summer internship, or you're starting your first job and you're flying up there, it wouldn't be a bad article to read. It's a really good basic article that really explains a lot about what we do in finance. But this is style analysis. Now, in reality, your firm might have FactSet, or it might have Lipper or Morningstar. They may have a database, and a database will do all this for you. So you might be asking, well, why in the world do I need to do this? Well, the question is, do you want to be great in finance, or you want to be mediocre in finance? The people that are great in finance, when they use Lipper or FactSet or Morningstar, they understand what that software is actually doing. They understand it. And so because of that, they can interpret the data much better. So those software packages are doing exactly what we just did here. We're comparing the returns of our fund, and we're finding the best fit. We're using Solver, but we're finding the best fit that explains the risk of my portfolio. And that's what style analysis is all about. All right, so the last thing we do is manager attribution. So manager attribution is going to be a little bit more difficult to set up. It takes a little more time to explain, so we won't get through it entirely in this class, but it is an incredibly powerful thing for you to learn. So I'm really excited about showing it to you. I'm hoping when you do manager attribution that you won't just do it for this project, but you will actually pick a fund so you can give insight to somebody. So you might actually call your parents, call your rich's uncle, find someone who has a mutual fund they really love, and tell them you want to do a manager attribution of their fund. You could do the same thing on the style analysis. If they've got a balanced fund, say, wow, I really like my Vanguard Star account. You can say, hey, I ran a style analysis on that, and let me show you what you have in that fund. It's different than what your prospectus says, so they're not quite being honest with you. Here's the true risk of your fund. I mean, you can do that, but manager attribution, I think you'll find even more powerful. So let me show you how to get that set up. Okay, so manager attribution, what we're going to do here is assess how a portfolio manager has done that. Be real careful on this. A few students get really confused on this. I know it's tough, you're watching these videos. So what we want to do is make sure everybody's real clear on the difference between style analysis and manager attribution. So remember, style analysis, you're using a balanced fund, stocks and bonds. For manager attribution, you want a one asset class fund, usually a stock fund. Stock funds work the best. So for example, you might want a US large cap fund. So you don't want them to have US and non-US stocks. You don't want them to have large and small cap stocks. You want them to be all US large cap or US small cap or US small cap value. So you want one asset class. And what we're going to try to figure out is this manager doing a good job managing their US large cap fund. All right. Now I'm going to use the Fidelity Contra Fund. It's a popular fund. It's a huge fund. It has a tremendous history. So I'm using that fund, which means just like with the style analysis, you can't use the VBINX. So for manager attribution, you cannot use the Fidelity Fund. So what do we do? It looks real similar to what we did with the style analysis. So the first thing we're going to do is go find a mutual fund. Find our mutual fund. So again, I'm going to use the Fidelity Contra Fund. There it is right there. The Fidelity Contra Fund. You can see it's a $130 billion fund, $131 billion fund. If we look at the holdings, what we'll notice is that it really does one thing, and that's stocks. It's all stocks, and they don't tell you here, but it's huge stocks. So it seeks capital appreciation, invests primarily in common stocks. Its company's value, the investor believes, are not fully recognized, so it's somewhat of a value investor, although it's a little growthy. It says contra fund, which implies it's buying stocks that are out of favor, but we'll see. We're actually going to test this and see where it belongs. So we're going to do the same thing, go back to historical data. We'll click on the max. Here you see it goes back to 1980. So I'm actually going to go back, instead of 1231, I'm going to do 1201, 1987. You'll see why I want to do that. So a little bit different. So we'll go back one extra. I know I said 1231 before, which is fine, but if they have data back that far, the reason you want to go back a little bit further is we actually want December, the end of December, so we can calculate January's return. So we'll do done and apply. Alright, so you want to make sure you go back to right before January 1988. You want historical prices, and you want it to be monthly. Just like we did with the mutual fund. And then you download that. Just like we did with the mutual fund, we're going to delete, for the style analysis, we're going to delete everything but the adjusted close. And you can see here we got 1287, so I'm actually going to calculate my returns. My returns are going to be January divided by December minus 1. So that gives you the return. I'm going to change that to a percent, and then click on the little box there, and you get that all the way down. Do control down because we don't need anything after December 2020. Delete those. So there I got my returns. What I'm going to do is actually, I just want the returns. I don't want anything else. So I'm going to take those, I'm going to copy, I'm going to paste them as values. So now I've got my returns. You notice that they're all values, they're not formulas. So I can now get rid of column B, I don't need it now. And so I can take the date, start with the date where you have a return. You don't need 87. Start with the date you have return, highlight, control copy, and go over to the attribution and go down to row 4. Alright, row 4, and right click and paste that. And here you want to highlight that and make them all percents. And so here we had the Fidelity Contra Fund. Here's my date. So we're going to do a little bit of test here. This is all we're going to do in this one, is we're going to test this first. So I want to know, is this US large cap? Is this US large cap growth? Is this US large cap value? Alright. So what is this? If I look at my asset returns, there's the S&P 500, that's US large cap. There's large cap growth, large cap value. So that's what I have starting in January 1980. So what we can do on Manager Attribution, you just hit your equal key and you go find that. So US large cap, that's the S&P 500. So go to Asset Returns, Paste Values. Get that very first one for the S&P 500. And do the same thing for growth, large cap growth. And do the same thing for large cap value. I'm going to take these, I'm going to copy them down. Now why would I bring all of these in? And the reason I'm bringing them in is I want to know which of these is the best match for contra fund. So I'm going to do equal correlation, equal C-O-R-R-E-L. I'm going to do the contra fund and hit F4 to lock it in. So you have $B, $4, $B, however many rows you have, and in comma. And I want to highlight the S&P 500. Just Control Shift down, close. And so there's my correlation there. I'm going to copy that over. You can see it's really just large cap, what we call large cap core. It has the best mix to the US large cap. It's closer to growth than value, but it's better to have a mix. So you can see the correlation is 0.83 for large cap, it's only 825 for growth, and it's only 7.7 for value. You would think a fund called Fidelity Contra Fund that actually talks about they're looking for out of favor stocks would be much more correlated to value. You can see right there, you discover there's something unusual going on with this fund. So yeah, we're going to compare it to the S&P 500. We don't need the growth, we don't need the value, but if the growth or value had been the highest, we would have started with them. So that's the first thing we've got to set up, is we want to set up our data for our companies. So we've got that. We've got our company, the Fidelity Contra Fund. We've got the S&P 500, or for yours, it might be small cap growth values. If you look at the pace values, S&P 500 index, that's what we call large cap core. The Russell 2000 is small cap. So just know that. You just put it in your notes. S&P 500, that's large cap. Russell 2000, small cap. So if you got a large cap manager, you might compare them to the S&P 500, large cap value and growth. If you got a small cap manager, you might compare them to the Russell 2000, small cap growth and small cap value. So you may have to try a few different asset classes just to see where your firm has the best mix. Because you can see in what we looked in their profile, that really did not give a good description of what this fund is all about. So that's the first thing we set up, was we just got to get your data in there. The next thing we're going to do is we're going to get Fidelity. I'm just going to say Fidelity, not Fidelity Contra Fund, and get their alpha. So what is their alpha? Well, alpha is really, really simple. Alpha, remember this from your exam 1, Alpha is just their return minus the S&P 500's return. So their alpha in the first month, they beat the market by 2.23%, but then a few months later, they were down 1.3 when the market was up 0.86. So that's their alpha. The next thing we want to do is we want to link Fidelity, and we want to link the S&P 500 or whatever you're using. Sorry, I don't know why. I'll have to fix that. Link the S&P 500, link Fidelity. How do we link them? Well, right above your first period, you just put a 1. Just put a 1 in there. And so how do you link it? Well, you do equal that 1, go to that cell, times, open parentheses, 1 plus Fidelity Contra's first monthly return. Back over in column B, you hit enter. You do the same thing with the S&P 500. In fact, you can just copy that over. I would change it to 2 decimal places, not percents. So if you look at the S&P 500, it's 1 times, open parentheses, 1 times their first return. We can now copy that down. If you control down, you can see, wow, the contra fund has not done very well during this period. So we've got the contra fund. So $1 in the contra fund back in 1988 would have grown to $18.93. That's pretty impressive. But if you just stuck it in the S&P 500, you'd be up $31.32. All right, so I'm going to stop there. That's as far as we've gotten. So step 1, find the fund you're going to use. Step 2, get their data back as far as you can, but not beyond January 1988 returns. Get their returns and put those into your Excel file under Manager Attribution. Find the best match of the asset classes. You may have to experiment with 2 or 3 of them. Calculate the alpha, which is just your return minus the S&P. You want to link those two starting with $1, and you just link it by multiplying it by open parentheses 1 plus each month's return. Copy that all the way down. You do it for your fund, you do it for the S&P 500. That's as far as we got today. What we'll do next is we're going to do several different attributions. We already know this fund has underperformed on a return basis, but that may be okay because they may have lower risk. So we may discover, yeah, the return's lower, but the risk is much lower. We'll see. It's called a contra fund, so maybe so. I'll talk about some data issues that you might have that you may have to check out with these funds. So we may not be getting this period. There may be a few things that Yahoo Finance is not capturing, and the biggest thing might be the capital gains distributions. We may be missing that, which is pretty material, and in that case, I don't know exactly how we can adjust for that. So we don't have the best database here to work with. Bloomberg would be a whole lot better, but we can't get access to Bloomberg, so we're stuck with Yahoo Finance. So just be aware, if you do this analysis for real, you may have some data issues, and you can really see it here because it really does look like every December they do a major capital gains distribution. You can see the last several years that's been the case, and I'm not sure really how to get around that. Boy, it's consistent every single time. So even starting in 1988. So we'll have to figure out how to get around that. I'll look into it and see if I can figure out some way to adjust for that. But anyway, there's our data. We're ready to start doing the analysis. And so next time I'll show you how we'll do the actual analysis. If the data is a little corrupted, the analysis still makes sense. You can learn how to do the analysis. And then when you have access to Bloomberg, you can do everything we just did here, but use Bloomberg instead. And one thing I'll show you, this asset returns from Bloomberg. If you're on a Bloomberg machine and you type the ticker for your stock in one of these columns, you will get the returns for your mutual fund. So these are true total returns. This is what Bloomberg brings in, the Bloomberg machines, they bring in a true total return. So it's not distorted by capital gain distributions. So we got dividends taken care of, which is good, but we don't have the capital gains distribution taken care of.